Stephen Bell, Director of Multi-Strategy Investments at BMO Global Asset Management in the UK, will give us some worldwide economic, financial and political context on whether he thinks the bull market can continue.
Hello everybody. I'm delighted to have been asked to present at the think tank again. Disappointed I can't be there live virtually or indeed in person. But here we go. We're going to talk a lot about the virus, of course, because it dominates everything. And as well as the world economy, I'll be discussing US politics. And the big question is, will this bull market continue, if indeed it has continued since I've made this video? Let's start with a very simple chart of the number of new coronavirus cases. Simply the number, a 7-day moving average. And you can see here that initially the United States looked like Europe, but with a couple of weeks lag. And then as Europe improved, the US really took off with a second wave, hugely bigger than its first wave. In a way, it was the first waves of the Sunbelt states. Europe seemed to be doing really rather well in this process. Even as it eased lockdowns, the number of new cases was declining. Suppressing the virus seemed to be working in Europe, less so in the United States. But now we've got this second wave building in Europe, and the US has turned down decisively as a result of a rather shambolic treatment, quite frankly, but eventually they got the message either by government restrictions or by people doing it themselves. But these infection rates are still far too high. If we look at the chart on the right, again, it's the simple numbers, so it tells you which states were the real source of the problem. And the three most populous states in the United States, Florida, Texas, and California, they were big in this and have all seen a very substantial decline in the number of cases. But still, too many cases to allow a full return to the economy. If we have a look at some of the European countries, we can see the UK here, which was later in the cycle and handled it badly initially, then coming down really quite low, and countries, notably Spain and France, although the data are all over the place, having a really significant rise in infections. And Netherlands seems to be having 3 waves, never mind 2. And even Germany, that's the orange line at the bottom, they had a very good initial wave, but it's picked up again, not huge, but still it's picked up. So the conclusion from this, I thought around about July and August that we were suppressing the virus successfully in Europe. China has, of course, eliminated the virus to all intents and purposes, and the United States really just needed to get its act together. So for the developed world, that policy was working. I've now changed my mind on that. There are limits to this policy of suppression. If we look at some selected emerging market countries on the left, we have India and Brazil, and we're never really sure if this data is terribly meaningful. Those countries really can't do proper social distancing in many cases. They don't have the same level of healthcare systems, nor can the economy withstand a serious lockdown. Yet some other countries, notably Mexico has roughly half the population of Brazil. That seems to have a much lower incidence. But let's be clear about this. These are very weak data from a statistical sense. The data on the right relate to the United Kingdom, which is the only country in the world that I'm aware of that has this quality data for testing infection rates in the general public. In other words, not those who've had a test because they've got symptoms, gone to hospital, or are part of the contact tracing method. Now, the bar charts show the average level of infection in the general community. That's not in hospital or other institutions. So what that means is that it's a proper randomized measure of the true level of infection. And as we had a lockdown, our rate went down. Though the lines, by the way, they're confidence intervals. Because they're samples, there's an uncertainty. But if you look at these bars, it shows no real change in the infection rate. And what seems to have happened is that because we are tackling local lockdowns effectively, we are keeping the overall infection rate down. And yet we're seeing a big rise in new cases. But of course, I think an awful lot of that is due to people asking and getting more tests. And in particular, those that need the test are getting it. So in my opinion, many of these data in Europe and in the United States do not reflect the true rate of infection. In addition, the second waves are very much amongst the young. In Europe, over half of the people in the first wave were over 60. Now that's down to 1 in 8. In addition, doctors are getting much better at treating this, and some drugs are available. So hospitalizations are way lower relative to new cases, and fatalities are even lower still. So the message from this is that our policy of suppression of the virus has partially worked, but not fully worked. There's a limit. Social distancing basically limits a whole load of economic activity. So in terms of the recovery from the virus, as we'll see in a minute, the world's done extremely well, but it can't get back to full levels with this current policy. And that would be a negative for the world economy and for financial markets, but for a vaccine, which we'll come on to later. Now, what we have here, the chart on the left, all of these data on the left refer to GDP forecasts for this year on the year earlier. And it's a good summary of the recession and recovery. And it shows how those forecasts have evolved over time. So you can see that analysts cut their forecasts heavily in the spring as the virus spread, but they were slow to do that. I was amazed at how long it took to people to get to the really severe downturns in growth that this virus was clearly causing, because sectors of the economy were simply closed down by government diktat. But you'll notice that they flatten, except for my own country, which I'll come on to in a bit, the UK. They're generally flattening and beginning to edge up. And there's a good reason for that, because the data have come in better than expected. The chart on the right relates to economic surprises. In other words, they're the regular data series, mainly monthly, that we get released all the time. And you take the actual minus the consensus estimate. And Goldman Sachs do one and Citibank do another. And you can see that they were negative as the virus spread, but then got extraordinarily positive. And these peaks are far and away the highest we've ever seen in these series. So analysts were slow to cut their forecasts down and have been wrong in terms of the vigor of the economic recovery. And that means that economic forecasts are going to get revised up, in my opinion. And of course, part of the better performance of the economy has been the quite extraordinary response of policymakers. They learned their lessons from the global financial crisis, and they've been big, they've been bold, and they've been decisive. Chart on the left shows the extent to which interest rates have been cut. Yes, they haven't been cut as much as they were in the global financial crisis, because they're already low, but look how much faster they were cut, even before the recession. Whereas in the global financial crisis, that shaded area was the recession. It was a year or more later. Fiscal people have been even bigger and bolder and decisive. This US fiscal expansion is absolutely enormous. Some of it reflects the effect of the recession itself, the automatic stabilizers, but the discretionary move was 10% of GDP. That's 10% of a year's GDP, whereas, of course, it took effect over a few weeks. So in many cases, incomes rose strongly as a result of the fiscal support. In fact, the savings ratio in the United States and many other countries has actually risen during this recession, completely the opposite of what normally happens. Now, this is a very buzzy chart. I'm sorry about this, but it shows the size of fiscal response in different countries. And at your leisure, you can read the mnemonics for the countries on the left. So the left is simply the fiscal stimulus, and you can see the US at the top, Japan and Germany pretty high, as is the UK. On the right, we add in these non-budgetary measures, most of which are loan guarantees. And again, you can see Germany and Japan in second and third place. They can afford these measures. Italy, well, it can't. And let's hope that not too many of these contingent liabilities click in, because it's a huge number. Now, the other thing to note, though, is Italy does not have a problem at the moment. The European Commission is not even going to look at its budget deficit until October next year, because it's abandoned this Growth and Stability Pact, and no one cares about budget deficits at the moment, but there will be a problem towards the end of next year. For now, Italy's fine. But again, substantial support and very different ranges across countries. Now, This is a very important chart. The chart on the left is the rate on US inflation-protected securities, 10-year TIPS. So it adjusts for consumer price inflation. And the latest number at around -1% is the record low we've ever seen for this series. And to me, it represents the ultimate risk-free rate. It's the rate that discounts all future securities. So it's a support for the stock market. It's support for every asset with an income, but it's particularly support for gold, which isn't really an inflation hedge, but it is something. It's a bond without a coupon. It's an equity without a dividend yield. So when interest rates are negative, zeros are not bad return. And that reflects very substantial interest rate policy by governments, not just cutting interest rates to zero and below in some cases, but also pushing down long-term interest rates with QE. Chart on the right shows the massive rise in US unemployment and in initial unemployment claims. There has been an improvement, still a long way to go. The basic policy in the US has been to let millions of people get fired, but give them generous unemployment benefit. Here in Europe, we've actually kept them attached to their workers with schemes like the UK furlough scheme or the European short-time working scheme. And those are schemes that developed countries can afford. They're not schemes that poorer countries can afford. And of course, the US generous unemployment benefit, which in many cases was higher than the wages that those people were earning before, that's expired. And Congress and the White House have failed to agree on a package of support. And that's quite a significant issue because we're talking about big numbers here. They might still agree one, but the chances of agreement have actually diminished. Now, we use the Purchasing Managers Index to get a real-time read on the economy. And some of these charts, I think, are quite interesting. First of all, the US had a weaker recession, a smaller recession than Eurozone. But as the second wave hit, it looked as if the US was losing that advantage. And we can see that in the lower chart, which is the US minus Eurozone for the composite PMI, which roughly speaking corresponds to GDP growth. But that gap was only briefly in Europe's favor, and now the US has gone on again. And they have been remarkably resilient in this recovery, remarkably resilient. We got some high frequency measures. One of the things that we have, we've never had this before, are daily, indeed even more than daily data on economic activity. And you can see again a very significant recovery. But looking at the chart on the right, you can see a flattening since the lockdown restrictions were imposed on the Sunbelt states. It's pretty much been flatlining. There is hope for an improvement. New York City just recently allowed indoor dining, but we'll have to see how it goes. Again, the policy of suppressing the virus has had its effect, but it limits the amount of degree to which we could recover economic activity. Let's not forget the enormous trade tensions or strategic tensions, political issues that are occurring between the US and China. I'm not going to talk very much about Brexit today, but that's another issue that faces the world economy, particularly the UK, of course, but that is a breakdown in trade relations. The only time we've really negotiated an exit from free trade. And of course, the US presidential election. We can see Donald Trump's approval rating. To my mind, it's amazing it's so high, quite frankly. But really, when it comes to winning the White House, it's really about individual states, and even more so when it comes to who's going to win the Senate. So this is the predicted market, which is the betting market for what experts and people who are willing to put their money where their mouth is think is going to be the outcome. Now, it's always been the case that the Democrats were going to retain control of the House, but what's really changed is the prospect of them regaining control of the Senate. And when those numbers, if the Democrats win the White House and the Senate, they can impose all of their legislative program. If they don't have the Senate, it becomes much, much more difficult. Now, as those protests against the police shooting of 2 black people have erupted, ironically, the looting and the rioting, not the protesting, but the former, has played into Donald Trump's law and order argument, but that seems to have been lost. It was a brief gain, and now it's looking at 57% chance of the Democrats getting, well, the Senate, a 57% chance of winning the White House. And they're probably the same numbers. In other words, if they win one, they probably win the other. And although people point out that Biden is more to the center than, for example, Elizabeth Warren or Mr. Sanders, he is still, to my mind, quite a left-wing president. And he would raise corporate taxes, maybe not immediately if the economy is still in recession. He would regulate more. He would possibly split up Facebook and Google. We don't know. But it would definitely be less favorable for the business community. Although he would get a big, long-awaited infrastructure program, which would have significant offsetting effects. And he wouldn't be so hawkish on tariffs. He'd be more worried about human rights in China than the tariff issue. Back to Europe, I've just plotted the individual PMIs there, and this demonstrates something that is unique about this recession. It was all about services. Normally, services are much more robust. We initially had a big fall in expected inflation, which is indicated by this chart on the right, but there's been something of a recovery. Nonetheless, at 0.8, people are still expecting European to be way below the European Central Bank's target. The UK, the narrative around the UK is that we've had a much worse recession than any other country in the developed world. And that was true in Q2, but that's just because that's how our lockdown matched that 3-month period very accurately. In fact, in terms of purchasing managers indices, we are doing better than Europe, and our recent data has been very, very strong indeed. High frequency data confirms this. The electricity usage is all over the place. A lot of people didn't go on holiday in August, and so it was very high. But the retail spending, which are these charts on the right, even the offline spending has recovered significantly, and the total is at or above pre-COVID levels. So although we've got a long way to go, and there is the limit set by social distancing, we have had a significant recovery. As far as China is concerned, again, a very busy chart, but on the left, I've plotted the 3 purchasing managers indices for China and given the latest number. And in each case, they're slightly above or at pre-COVID levels. So almost a complete recovery because of the severity of their lockdown and the ability to make people comply with that. The rest of the world is catching up, but not quite all the way. As far as emerging markets are concerned, I've done the same chart on the left on monetary policy, and the big change for emerging markets is that their low inflation has allowed their central banks to cut rates aggressively, and that's been a huge benefit. The dollar hasn't been particularly strong, certainly not recently, and that's eased it a lot. So although they have severe problems with the virus, they have a very significant response on monetary policy. And their purchasing managers index fell less and has recovered more. And that's quite a positive against all the negatives from the virus for emerging markets. Now, where goes the economy, so goes corporate earnings. These charts give us an idea of how earnings expectations have evolved during the course of this year. But the chart on the left is MSCI all countries rather. So that's basically world earnings per share growth. And I call it the squiggle chart. The blue line on the left related to 2012. What that tells us is at the beginning of the year, analysts, this is bottom-up expectations by adding up all the analysts' forecasts, we're expecting low double-digit growth in earnings. In fact, almost every year they expect low double-digit growth, whatever the cycle, whatever the weather, because they're always optimistic about their sector. And as the year progresses, they revise the numbers down, on average by 5 to 8%. It's a rare year where the numbers get revised up. This year, of course, they've been slashed. But notice a little uptick there. Very important. The downgrades have stopped and are beginning to be upgraded because the similar pattern has happened with the economy. If we zoom in, we get a decent quarterly picture from the S&P 500. It's the same thing, the evolution of analysts' bottom-up forecasts as time continues. Q1, of course, is an outturn, and Q2 is largely an outturn. And you can see that having beaten down earnings expectations to a massive 44% decline, the outturn has been way better. It's been a record earnings season in terms of beating estimates. So it's a record negative in terms of the absolute number, but a record beat by earnings. Now, what about the future? We think the earnings estimates are headed higher. The chart on the left The orange line is our model of what will happen to analysts' forecasts year over year. So this isn't actual earnings, it's analysts' forecasts of earnings, which is what drives the market. And on the right, the orange line is the outlook for company profits as measured on a Bloomberg screen, and that reached a record high. It's normally an average negative. That number doesn't go back all the way, it was a record high. It's come off the highs, but it's still improving, and it was followed by this big improvement in analyst upgrades. The more familiar blue line is the number of analysts revising up minus those revising down as a percentage of the total for each analyst for each company. Right, we've seen the limits to the world economy recovery. It's going well, but it will be limited, can't get back to full recovery given the policy suppression has limits. But the vaccine offers us the prospect of a full recovery. Now, it says here 9 vaccines in phase 3 trials, there are actually 7. There's about 150 in earlier trials. The Oxford vaccine is way ahead of the others in many ways. It has several advantages, can be mass produced early, easily, and more particularly, it can be stored by merely being chilled rather than minus 70 degrees centigrade, which is what the Pfizer vaccine and many other vaccines require. Phase 1 trials are to test that it produces antibodies and T cells, and phase 1 and phase 2 do that, and that it's safe. So there's a very high chance that it will work in terms of stopping the people getting seriously ill. There's lots of other things to think about. It's been paused because one person was ill and they couldn't immediately find the cause. It's almost certain that that person will be declared okay. They're discharged today probably, and the trial will probably resume tomorrow. Anyway, there are other trials. The Chinese vaccine made in the more traditional way by killing an existing vaccine, that's also looking pretty good. So one way or another, I think we'll get a vaccine. If it's the Oxford vaccine, the UK will get deliveries of 30 million doses this month. The US might have it by the 3rd of November. Trump certainly wants it in order to start the program in the US before the general election, presidential election on the 3rd of November. So I think the chances of a vaccine are very high. The nature of this virus makes it susceptible to vaccines, apparently, unlike the flu, for example, which mutates very easily. And if we get a vaccine and we have this mass rollout problem, it's only a matter of time before we beat this virus. Yes, there will be resistance to the vaccine, of course there will be, and that resistance might be increased by social media and so forth, but I still think the evidence from other vaccines is despite campaigns against them, they will have a big take-up. And I think that is the really serious positive outlook that we have at the moment. So, the virus is fighting back, but when we get a vaccine, it will be a game changer. Now, people now expect a vaccine. A recent survey by Deutsche Bank said that 38% expect a vaccine within 6 months. That was up from 12% the month ago. But it's still 38% is not even half. So I do think that that would be a positive factor. We do have political uncertainty. I think Biden would be, with a clean sweep, quite a business negative force. I think the tensions between the US and China are a negative force. And I think there's an awful lot more priced in for the financial markets because it's rallied so much. And our measures of flows suggest that the pushing pressure that's kept this rally going is much weaker now. In addition, I would normally ask for questions now, and a question I would always get asked is, won't this huge budget deficit and monetary monetization lead to inflation and higher interest rates? I say no, because even though I think we regain pre-COVID levels of economic activity by the end of next year, there'll still be slack. Therefore, downward pressure on wages, downward pressure on prices. Yes, there will be some price increases. Airfares will be higher next year than this year, I confidently predict. We'll just have fewer flights. But do you think wages are being pressurized up? No, not until economies fully recover. The pressures are the other way around. And when it comes to interest rates, governments are getting these huge debts rolled over at extremely low rates. And I think central banks will keep the front end very, very low. And low bond yields might go up, they're going to stay low. So there's no real pressure on governments to slash their deficits or indeed to get that spiraling where higher rates lead to higher deficits. So it's been a heck of a challenge for the world economy. Life will never be the same again, but I think this background is mildly positive for risk assets. There will be more setbacks as we've had recently, but I think risk assets are better than bonds. I think commodities will do quite well as the world economy recovers, but I think equities will give you the better performance overall. Well, it's been a real pleasure talking to you, even if the dialogue has been one way. I very much hope to see you in London next year. And may I wish you good luck and good investing. Bye-bye now.